Hello and welcome everyone to the Ninepoint Outlook on Gold and Silver Investing. My name is Neil Ross. I'm Managing Director National Sales with Ninepoint, and also with me today is Maria Smirnova, Senior Portfolio Manager with our partner Sprott Asset Management. So this is a look at the agenda for today's webinar. First, we're going to give you a very quick overview of our firm. Then Maria is going to give a macroeconomic update, and the outlook for gold and silver specifically, and then an update on two Ninepoint funds that she sub-advises, the Ninepoint Gold and Precious Minerals Fund, and also the Ninepoint Silver Equities Class. To begin, I want to start by saying a few words about who we are. Based in Toronto, Ninepoint is one of Canada's leading alternative investment firms. Now, notably, in this age of investment firm consolidation, Ninepoint is fiercely independent, privately owned, and proudly Canadian. The focus of our firm is entirely on providing investors with innovative ways to truly manage risk in clients' portfolios. And we do this with a diverse set of mandates. So at this point, I'm going to turn things over to Maria Smirnova from Sprott, and she's going to begin with her macroeconomic update. Maria?
Thank you, Neil. As Neil mentioned, I will cover the three main topics. I'll provide a macroeconomic update and outlook, our outlook on gold and silver, and then I'll give brief updates on the Ninepoint Gold and Precious Minerals Fund and the Ninepoint Silver Equities Class. So let's begin by reviewing what's happened this year so far. We're in September now, so we've had about 8 or 9 months this year. The last several years actually have been quite difficult ones for precious metals investors. As the general markets have been roaring to new heights, gold has been relegated to the status of a relic. Gold saw a low of $10.50 an ounce at the end of 2015 as the Fed was preparing to start raising interest rates, and since then, gold has attempted to break the $13.50 psychological level several times, but really traded between $1,200 and $13.50 in that range. But when it became clear that both the U.S. and the European central banks were preparing to start monetary easing or continue it, gold broke out after the June FOMC meeting, and it's now trading north of $1,500 an ounce. Silver, on the other hand, underperformed gold until July 16th, but then it finally broke its downtrend and sent the gold to silver ratio lower and sparked a rally in silver equities. Year to date, gold bullion is up 17% and silver bullion has gained about 21%. So silver has actually outperformed gold so far this year. These rallies have been precipitated by central bank U-turns. The Fed cut its benchmark interest rate by 25 basis points in July and is most likely going to cut it again this month. The ECB, on the other hand, has adopted a formal easing bias on rates and sent a very dovish signal regarding its plan to deliver a broad easing package in September. The ECB will debate this next week, September 11th and 12th, and they will debate whether it will expand or relaunch a giant bond buying program or whether it will cut interest rates further below zero. The ECB's key interest rate is already at -0.4%. The easing isn't happening fast enough, though, for some political leaders, and President Trump is known to criticize central bank officials. An important factor contributing to global economic weakness has been an escalating trade war between China and the U.S., and I will talk about this more later in the webcast. On the mining front, the last 12 months have witnessed two large M&A deals. So Barrick merged with Randgold, and Newmont combined with Goldcorp. These two deals created two of the largest gold mining companies in the world. This really marked the gold market bottom, and this was around the end of 2018 and the turn of this year. So now we are waiting to see what other deals will happen in this space. Larger gold miners are struggling to extend their dwindling reserves, So buying assets is one way to boost mine lives. So let's review a few charts now that inform our views on the gold and silver front and tell us how we got to this point. The first one is a chart showing real annual GDP growth, and that is in blue, together with the federal funds interest rate, the gray line. You can see that while real GDP growth has been volatile over the last 6 decades, growth has slowed on average in recent years. At the same time, interest rates have never before been at or close to zero as they have been in the past several years. The monetary easing that the Fed has instituted post the global financial crisis was designed to stimulate the economy, and it did, but not with great results and not the results that some people have anticipated. In the past, central banks have been able to fight economic slowdowns by lowering interest rates in order to stimulate lending, which in turn would encourage investment. But what has happened in the last easing cycle is that companies borrowed money but used a lot of the proceeds for share buybacks and dividend payments. And what we're seeing now are signs of slowing economic activity once again, so we expect GDP growth to turn lower once again. And the central banks don't have as many tools in their back pocket to stimulate the economies. This next chart shows, again, the Fed funds rate, the gray line, but this time we're looking at it together with the United States budget balance. That's the blue line. So this chart goes back to 1995, and the declining blue line means an increasing deficit, as in bigger negative numbers. In the past, the Fed has eased monetary conditions when the government's budget deteriorated. And this is the first time that the Fed is tightening, or was tightening directly into an exploding deficit. So see the two lines coalescing at the end there. And of course now we're seeing the Fed reverse its course and starting to ease again, cut interest rates. So central banks, again, are literally running out of tools to stimulate the economy. Deficits are growing, debts are growing, and one of the reasons is demographics. Let's take a look at that now. So on July 22nd, the Trump administration struck a deal that raises the budget caps for 2 years and suspends the debt limit through July 2021. The agreement resolved the debt limit through the 2020 election, but inevitably, demographics will make it so that some combination of significant tax and spending adjustments will be needed. One of the more negative trends has been the decline in the worker-to-retiree ratio. The decline in this metric began just before the financial crisis and will continue for the next decade before leveling out at a low historical level. In 2019, this ratio is expected to be at about 4:1 and is poised to drop all the way to 3:1 in the next 10 years. This development should continue to strain government budgets. So if we look at the costs of entitlements today, it would require more than 30% of private wages and salaries to fund these. This does not include the cost to fund government employee compensation. Including those, it would require 60% of private wages. These are effectively the tax rates required to fund these massive outlays, and these will only climb into the future as the population ages. And the question will be how to finance the entitlements. Short of having big increases in tax rates and of cutting entitlements, the government can just print more money, so monetary debasement will continue. So right now, the U.S. debt to GDP ratio stands at 106%. The debt burden will be a big theme into the 2020 election, and part of the reason I'm so bullish on gold. Moving on, this next slide shows the global negative yielding debt, and that has reached an astounding $17 trillion versus the gold price. As you can see, there's a pretty strong correlation between the two. So gold is definitely benefiting from an increase in negative yielding debts. And again, as various central banks around the world are lowering interest rates, That means the more and more debt will be negatively yielding, and therefore that's a tailwind for gold. So in terms of macro outlook, I've touched on several factors, why we are positive on gold and what's happening in the world. So the three main factors that we see that spark the gold and silver rally are weakening global economy and a weakening economic outlook, trade tensions, I have not touched on that, but I'll talk more about it, and political unrest. So on the global macro side, the outlook has softened materially since the beginning of the year. We're seeing signs of economic slowdown around the globe. We use PMIs as a proxy for leading economic indicators, as they have a lot of history, have minimal revisions, and are standardized across the world. A reading below 50 indicates contraction within the manufacturing sector. So currently, 71.4% of the world has PMIs are negative or less than 50. So this includes the Eurozone, US, China, Japan, Korea, Malaysia, the list goes on. US PMIs have been declining, and 8 of the 10 world's largest economies have declining PMIs year to date. The second factor is trade wars. The trade war between the US and China is intensifying. We read about a truce at the G20 summit in Japan a couple of months ago, but there was no real resolution there. And the truce was broken on September 1st when the US introduced 15% fresh tariffs on Chinese goods. This is on top of 25% tariffs already previously imposed. China retaliated and targeted imports of soybeans, crude oil, and pharmaceuticals. Beijing also lodged a complaint with the World Trade Organization over the tariffs. It is hard to overstate the role this escalating trade war is having on the world economy. It is hurting business confidence, crimping trade in Asia, and hitting export-oriented factories in Europe. Economic confidence among small U.S. companies fell to the lowest level since 2012 in August. The economies of Japan, South Korea, Taiwan, Indonesia are all feeling the knock-on effects of the trade war as their exports to China are dropping and manufacturing activity is declining. In Europe's economic engine, Germany, which is a leading supplier of machinery and equipment, manufacturing activity is also being hit with factory orders down 5.6% year over year in July. Going forward, additional 15% tariffs on 156 billion of Chinese goods are set for December 15th, and the prior 25% tariffs will become 30% in a month. So this trade war is not going anywhere, and if anything, is getting worse. And the third factor on this page is geopolitical risk, and that has definitely played into gold this year. Iran has been making news headlines. So on July 7th, it was reported that Iran would breach the 2015 nuclear agreement for the second time by enriching uranium above the agreed-upon 3.67%. This broke the nuclear agreement in an attempt to put pressure on Europe, China, and Russia to do more to offset U.S. economic sanctions. To this, President Trump said, Iran better be careful. And most recently, on September 5th, Iran said it would abandon constraints on nuclear research set out in the 2015 deal. This move was in response to the Europeans' inability to cushion Iran from the effect of U.S. sanctions. So the second part of our look is basically this little chart is showing that slowdowns after cycles of Fed tightening have been harder than slowdowns after no tightening. So hard landing versus soft landing. We are right now coming out of the longest expansion in history in the U.S., and this is the third slowdown in this cycle, so from 2008. But this is the first slowdown after a Fed tightening cycle. So the Fed funds rate, in fact, is at a 10-year high. There is a lag between the rise in rates and growth, how it hits. It's about 18 months lag. So we finished the hikes at the end of last year, so we still have at least about a year, actually, for the effects to take place. So therefore, we think this slowdown is going to continue, and it's going to be deeper than prior ones. The result of all this has been an easing spree by central banks who have cut rates 32 times so far this year and have eased monetary policy by almost 14% cumulatively. And also the survey said basically another 58 moves are expected this year, or not this year, sorry, another 58 moves are expected for a total of 16%. This was predicted on September 4th, and already it's out of date as Russia just lowered its rate on September 6th again. So what we're expecting going forward is continued declines in GDP growth, slowdown in GDP growth, slowdown in manufacturing PMIs, declining earnings growth, and a continuation of this central bank easing in various forms. And we don't know what forms it may eventually take on, but interest rate cuts are the first step. And of course, this is all positive for gold as a portfolio diversifier and a real asset. So I've touched upon gold and silver now, but let's look closer at the two metals and how they've done lately. This first chart shows simply the prices of silver and gold. We can see that gold peaked in 2011 at $1,900 and silver peaked at about $48.44. Now though, gold's back to $1,500 and silver to $19 almost. We're still very far away from the tops. While we focus on U.S. Denominated prices, gold's actually hitting record highs in other currencies. Two of the key currencies are Canadian dollar and Australian dollar, and gold is more than $2,000 an ounce in both of those. And of course, if things unfold as we think they will, gold and silver will be materially higher going forward. So the ETF chart simply shows that investor attention has been turned to gold and silver lately. Investor demand is coming back. Since June, we've seen gold ETFs gather about 9 million ounces and silver ETFs are up 120 million ounces. This is all in 3 months, so that's a nice pickup. And we're also seeing coin sales up in the U.S., and we're seeing increased net longs on the COMEX for the metals. Let's zoom in on silver for a minute. This chart shows the gold to silver ratio going back to about 82, and the average has been about 65 to 1. Silver really underperformed up until recently, and the gold to silver ratio hit as high as 94 to 1 or 93 to 1. It's now reversed and broke the uptrend, and silver is beginning to outperform gold significantly. And silver does have that potential to outperform gold in bull markets. For example, in the wake of the global financial crisis, the gold to silver ratio went to 80 to 1, but then bottomed at 32 to 1. But that's when the silver price went close to $50 an ounce. And recently, the ratio hit the high, and now we're coming back down. Again, recently silver was at about $15 to $16 an ounce, and now it's $19 an ounce, and now it's outperforming gold. And we think there's significant room for silver to run still. Again, investment demand is picking up. Silver is significantly cheaper than gold, so it's easier for investors to buy it. So again, we're pretty bullish on silver as well. This is a busy slide. It just shows the history last 10 years or so of the silver supply and demand. And I show this slide because I want to illustrate one simple point. Silver has been in physical deficit for many years in the last 10 years. And last year we recorded another deficit. So there's a very strong fundamental argument for silver outside of the investment argument, and really investment demand is the swing factor, and that's why it drives the price. So in terms of the supply, scrap and mine production are the two main factors. Scrap has really been low in the last few years. Why? Well, because the price of silver has been low, and hence people don't want to recycle silver. Now that will pick up a little bit when as the price goes up. But in terms of mine production, that is the lion's share of supply, we see the trend down. And that is because really we have not seen a lot of exploration or development in the silver space. We don't see a lot of new mines coming on, and I wouldn't expect large growth in mine supply. On the demand side, jewelry demand has been stable to growing. Silverware and industry has been stable, and that is really the backbone of the demand for silver. But in terms of the investment, again, those coins that you see, the coins and bars, we're expecting that to grow. Already, year to date, coin sales in the U.S. alone are up 38% from January to July, so year on year. And again, as ETFs gather steam, as coin sales gather steam, that will provide support for the silver price as well. Turning now to company valuations, starting with the gold companies. Here we have the slide of the chart of price to cash flow multiples. And these are forward-looking 1 year out. Now, of course, some of the valuations have changed in the last 3 months. Gold stocks have come up, but they're still not at high levels of the mid-2000s that we saw previously. And also, I would keep in mind that these forecasts are based on sell-side analyst projections. And generally speaking, analysts don't revise their metal projections or metal prices quickly enough, and they usually lag. And therefore, as those projections start to come up, the multiples will obviously come down. As earnings of a gold company at $1,500 are materially different than at $1,300, because that $200 difference is all profit. And then the next chart here is the long-term gold equity to gold bullion ratio, and that really hasn't re-rated. This chart is as of August 30th. We're still at multi-year lows for gold equities versus bullion. So again, we see a lot of upside in the equities versus the bullion. And similarly for silver companies, silver stocks have run up in the last couple of months. Again, keep in mind, this is consensus. This is based on analyst expectations. And for next year, for 2020, the median silver price forecast is $16.30, but the forward curve is north of $19. So that makes a huge difference, $3 an ounce. That is all profit for these companies. So yeah, there could be a pullback. Nothing goes up in a straight line, as I say. But again, valuations are not very extended. I think as the silver price maintains or keeps going, these companies will be healthier. Will start, investing again in exploration, adding ounces, growing production, and these metrics will all change. So to summarize our gold and silver outlook, it really rests on the macroeconomic picture. And that's because that dictates the investor interest. And we believe that in times of uncertainty, in times of market volatility, economic slowdown, this is why investors are turning to gold and silver now, and we think that will continue for the next little while. And I'm personally a fan of Ray Dalio's macroeconomic work. He studies economic history and has published an article called Paradigm Shifts. I highly recommend reading this article. In it, he talks about the decades since the 1920s and how they align with paradigm shifts. Every decade has its own characteristics, and since we're close to the turn of the next decade, it is interesting to think what will happen in the next decade. What will 2020s be like? Mr. Dalio believes that the central banks will run out of stimulant to boost the markets and the economies, and there will be an enormous amount of debt and non-debt liabilities, such as pension and healthcare, that will increasingly be coming due and won't be able to be funded with assets. There will have to be some combination of large deficits that are monetized, currency depreciations, and large tax increases. That's what he believes. That's what he stated in his article. And of course, I've talked about a bunch of these things, and we're seeing all of this coming around. We're seeing increasing deficits, growing entitlement commitments. We're seeing central banks around the world trying to stimulate their economies, mostly not very successfully. So we're in a gold-positive environment, and that is exactly what the article concludes. Mr. Dalio concludes that gold is a good portfolio diversifier, being risk-reducing and return-enhancing, and we could not agree more. Turning now to the Ninepoint Gold and Silver Funds, let's start by chatting about the management team, the portfolio management team. That includes myself, Jason Mayer, and Shri Kargatkar. I have been at Sprott since 2005, looking at mining and metals. Jason has also been at Sprott for a while. He also manages our flow-through business, and he's very well versed in the spectrum of companies, from the very junior companies to the more senior ones. And he's a great resource, particularly when we're looking at small exploration stories. And Shri joined us in 2010. He kind of also traverses the globe. His specialty is Australian companies. Mining is quite big in Australia, as you may know. So he's done a number of trips, and he's scouted out Australian investments for us. And he's a great resource in other ways, doing quantitative work and other research. Of course, we have an invaluable technical team, 3 gentlemen who support us. They're all geologic economists, or economic geologists, I should say. They have a wealth of knowledge and experience both in industry and on the investment side. Andy, Neil, and Justin, we speak to them weekly, if not daily, especially when it relates to, again, more junior exploration stories. They provide that geologic kind of backing that sometimes we don't have. And they also have the industry, they know a lot of people in the industry, so that are oftentimes help us out with pointing us in the right direction when we need specific advice on things, and talking to various people as well. So our core philosophy, we believe in gold as a diversification for traditional asset classes. We believe that gold equities provide leverage to appreciating gold prices. And we're global. Again, I mentioned Australia. We invest in companies that are based anywhere in the world pretty much. There are certain areas where we do not go, but mostly we'll go around the globe. And we are tactical as well, as we have core and tactical positions, so we can move our positions around when needed. In terms of portfolio construction, we begin with the meat and potatoes of the portfolio, with larger positions being in generally larger companies. These are typically producers. They have good trading liquidity, and in those we focus on free cash flow generating. And an individual position will be between 3% to 6% in this category. And then we layer on smaller positions in developers and explorers. These are less liquid names. They may not have, or generally don't have, cash flow. So you have to size the positions appropriately. And so these positions are generally between 0.5% to 3%. So what we look for are management teams with track records of success. In other words, we look for those people that we get to know them throughout time, and we make sure they deliver on their promises, and those are the people we can trust. And in terms of producers, I mentioned we look at free cash flow. We're very punitive in how we generate free cash flow. We do it after most all capital that is invested. And normally people don't include growth CapEx, but we do. We look at all those numbers, and we look at the bottom line. And then for explorers, we look for deposits that have the potential to be large and high grade and highly economic. And we stress test all the numbers. For example, if somebody releases economic study, we will stress it and put our own assumptions on in terms of costs, et cetera, cost to build, cost to operate, et cetera. And then with that, we overlay other factors, the location factors, infrastructure, political, fiscal situations. In mining, it's critical to have water, power. You need to have the right topography sometimes to make sure you have a place to put your plant, et cetera. These are all the factors that we look at, and that's what we do. And then, of course, we consult our technical advisors, and like I said, particularly on the smaller names where geology plays a bigger role. Looking now at the Ninepoint Gold and Precious Minerals Fund, here you have the history of performance to August. Generally, we tend, because we're smaller and mid-cap biased, we tend to outperform the index in uptimes, and that's what you see on the chart. But our top 10 holdings are really still, like I said, focused on the producers. We have about 20% exposure in silver in the fund through silver producers. We also have some exposure to Australian producers, some West African producers. So the top 10 and the holdings overall are quite diversified in that sense. Similarly, for the Ninepoint Silver Equities Class, the fund is up about 37% year to date. Again, the top holdings here are mostly producers. And the one name that sticks out is Silvercrest. It's an explorer and developer in Mexico. It's the second largest holding. But outside of that, these are all producing companies. And now we will proceed to the Q&A section of the presentation. Okay, sorry about that little delay. I have here in front of me a list of questions that have come in over the last some time. So the first one is, should I buy gold bullion or gold stocks? Well, it really depends on your situation. Really, that will be the answer. If you have a really low risk tolerance, then I would stick with gold bullion. But if you have a little bit of a higher risk tolerance, and you could go and buy a mixture of the two or gold stocks. Ninepoint, as I spoke about, we also have a silver equities fund, and if you want to be a little more aggressive, you can also buy the Silver Equities Class, which invests only in silver stocks. So you can do any combination of that, and really, again, it depends on your situation. The next question is, what caused the decline from over $1,800 to now $1,500? Well, really, if we think about the last decade and the last 6-7 years, when gold reached its high, we were going into, we came out of the financial crisis, but we were going into a time period of economic growth and where banks were starting monetary tightening. And as I discussed, rates were going up, the environment economy-wise was viewed as more positive and growthy. And that's why in an environment like that, nobody cares about gold, and it was sold down. And really the bottom was even less than 1,500. The reason gold has started to rally recently is because we're now entering a time period of slowing growth. We have seen slowing growth across the world, and we're now having reversals by different central banks, and we're seeing monetary easing. And I spoke about the ECB and the Fed and what they've done. What are the potential catalysts for a lower gold price? Well, again, it's a reversal of some of the trends we're seeing. For example, if we're seeing a pickup in growth, gold could be weak. If we're seeing a resolution of the China-US trade and a reversal, importantly, the reversal of tariffs, that could bring weakness to the gold price. Now, our view fundamentally is that the damage has been done. Interest rates, being raised over the last 2 years, that damage has been done. The tariffs are in place and have been in place for a while. And even though Trump announced that he's delaying an increase in the tariffs by 2 weeks, we think that the damage to the economy is already done. To trade, everything we're reading about what's going on with world trade and how it's affecting manufacturing and businesses across the world and exports, all of that stuff, that has already taken place. And now we're just seeing the outcome of all of those policies being enacted. So while we definitely don't, say that there won't be a pullback, there might be a pullback on the gold price. We are saying that buy the dips. We're in an environment where weakness in economies will continue. It will be harder and harder for banks to stimulate growth. So fundamentally, buy on dips. We are in a bull market. That's what we believe. So then the next question kind of flows from that. Have we missed the opportunity after the recent 2-month rally to get into gold? Well, and a related question, actually, somebody else asked, if this was a baseball game, what inning would you say we were in? Well, I think we're maybe in a second inning, I would say, out of 9. I don't think we've missed the rally. I think this is the beginning of the rally. And again, because there's a giant shift in policy across the world. ECB ended easing and now just restarted it again. The Fed's doing the same thing. Banks around the world are easing. That to us provides a fundamentally positive backdrop for gold and silver. Next question is, from November 2008 to November 2010, there was an increase in many PM funds of 4 to 5-fold. It seemed as though the juniors exploded in that period. Is this a possibility again, and what is needed to drive this? I keep hearing that juniors are significantly undervalued in spite of gold's current move. Why? Well, there's a lot to cover in this question. Yes, generally speaking, the juniors are cheaper than the seniors, and that's a normal occurrence in any part of the market, really. And that's because juniors simply have more leverage through exploration, through sheer size. When a dollar goes into the market, it'll have a bigger effect on a small company by definition. And we definitely think that the juniors will outperform the seniors. Normally what happens in the bull market is the first money goes into the seniors, so they outperform first, and then it starts flowing downstream to smaller and smaller companies. And that's why we position our portfolios slanted towards the mid and small caps, because we think that there's more upside to it. And there's also going to be upside through potential M&A. Again, senior companies are trying to maintain their mine lives. They're trying to maintain production. We haven't seen a lot of discoveries in gold and silver. And therefore, we think that juniors with good exploration stories, with growing deposits, they will be ultimately of interest to the senior producers, and they will have leverage from that aspect. There's a dire rarity in good deposits owned by juniors. We haven't seen a lot of good discoveries lately. Another question is, for many years, mine management have been poor allocators of capital, overpaying for acquisitions, then dumping at a huge loss when problems arise. Why is Sprott confident this is not still a big risk? Well, mining is really a cyclical business, and companies did overpay back, 7, 8, 10 years ago at the height of the market because, again, they were just looking for ounces. They were looking for projects to build, and you have to consider, and they had money to burn at the time, and they had the political capital, so to speak, to do these acquisitions. We've gone through a period of rationalization. We've gone through a period where investors have started demanding more, that management teams be more careful. And so we're hoping that, we won't see a repeat of overpaying for a while. Now, having said that, again, going back to my original point, we haven't seen a lot of great discoveries lately. So to me, by definition, it will mean that companies will be sometimes overpaying for what they're buying. They won't be stealing any assets. We have seen some acquisitions this year. There have been some acquisitions that have made a lot of sense to us. They were incremental. They were, not blowing a hole in the budget of a company. And then we've seen the opposite, where a company did overpay for somebody else. So I think you just have to be careful and know management teams, and that's where we come in. Again, we deal with these companies on an ongoing basis, and for example, next week I'll be in Denver meeting with a lot of our holdings and some new prospects. So I'm not exactly confident that companies won't overpay, but at the same time, what I'm confident is that the companies we own, the management teams, will do the right thing. Question about a replay. Yes, you will be receiving a link, I think, to a replay. Those who registered, tomorrow there will be an email going out with a link. Okay, another one. As a rule, when the value of the dollar increases relative to other currencies around the world, the price of gold tends to fall in U.S. dollar terms. As U.S. dollars keep on appreciating recently, how it will impact the gold price? Well, interestingly enough, the U.S. dollar has been appreciating this year, but yet the gold price has also been quite appreciating this year. So I think that actually the relationship has been stronger between the gold price and real interest rates, and that's what we focus on. That's what we watch more closely. Economies around the world are trying to devalue their currencies, and the U.S. dollar still is maintaining its status as a reserve currency, so in times of uncertainty, people buy the U.S. dollar. But it doesn't mean that people won't buy gold. So again, I would watch more interest rates and real interest rates and what's happening with monetary policies and fiscal policies around the world. All right, take maybe just a couple more. The Australian gold index miners have outperformed the Canadian